Hi guys. Today we will analyze Dollar Tree stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market, but there are some doubts in the very recent evolution. The short-term trend is negative. The long-term trend is still positive, but the trend can change at any moment. Support level is around $156. Strong support levels are around $120 and $107. Next strong support levels are around $96 and $78. Resistance level is around $176. In the last month the stock has been trading between $155 and $177 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 2.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 5% per year, for last 5 years. We see that the average profit margin of the stock has been around 3% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 52% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Dollar Tree Company: bad, average, and good. First scenario. Dollar Tree will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 3%. Future profit margin would be a low, 4%. Future free cash flow to net income rate would be a low, 40%. In this case, the fair value of the stock today would be $58. Second scenario. Dollar Tree will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 4.5%. Future free cash flow to net income rate would be average, 50%. In this case, the fair value of the stock today would be $83. Third scenario. Dollar Tree will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 60%. In this case, the fair value of the stock today would be $114. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.77. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Dollar Tree, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 20. Again, I will use 3 different scenarios for Dollar Tree Company: bad, average, and good. First scenario. Dollar Tree will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 3%. Future P/E would be a low, 17. In this case, the fair value of the stock today would be $54. Second scenario. Dollar Tree will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 19. In this case, the fair value of the stock today would be $66. Third scenario. Dollar Tree will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 21. In this case, the fair value of the stock today would be $80. As you can see, today the stock is overvalued, $159, even if we expect the company's high performance in future. The financial health of Dollar Tree is medium. Also, its profitability is quite bad. While showing a small growth rate, 3 to 5% per year, the stock looks overvalued at the moment. I may consider buying the stock, if the stock drops below $100. Company's strengths. Dollar Tree is an American multi-price point chain of discount variety stores. It operates 15,115 stores throughout the 48 U.S. states and Canada. Each Dollar Tree stocks a variety of products including national, regional, and private label brands. The company recently completed its $1 to $1.25 price point conversion, marking a monumental point in the company's 35-year history of maintaining a $1 price point. It will help offset recent inflationary pressures, and give the company the opportunity to expand product assortment, which is something its customers have been asking for. Even with higher price points, store traffic trends are expected to remain robust as Dollar Tree is prioritizing value. Small ticket sizes make it difficult for online retailers to contend with Dollar Tree's single price point model, as shipping costs weigh on their ability to compete profitably. As optimization efforts spurred by investor Mantle Ridge Daycold and the store network expands, Dollar Tree should leverage its supply chain and distribution infrastructure investments, generating resources to fuel its low prices. Risks. Inflationary pressures related to merchandise costs, freight, and labor. Weak price elasticities from decision to raise prices above $1. Waning pandemic-related relief, stimulus checks, unemployment benefits, child tax credits, and SNAP benefits. Fierce competition in the retail sector challenges Dollar Tree, particularly as digital and conventional retailers attempt to meet escalating consumer expectations for convenience, store experience, and low prices. Walmart, Target, Aldi, Dollar General, and other. Target's financial metrics look much superior to Dollar Tree's. The company has a return on assets of 6%. This is below the industry average of 8%. Its return on equity of 17% is worse than the rest of the industry. The industry average return on equity is 31%. Its profit margin of 5% is below the industry average of 6.6%. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue is expected to grow by 5% on average over the next 5 years. The company is expected to show a medium growth in earnings per share. In the coming 5 years, the EPS will grow by 12 to 16% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.